Hello. Hello, everyone. Welcome to day 3 of the Definiti Retirement Academy. I'm really glad that you're here today. We will be starting here in just a moment as we allow for people to join us. I'm hoping that you all had a chance to join us Monday and Tuesday and have learned a lot already. Reminder that we are recording all of the sessions and they will be posted next week. So you'll have an opportunity to catch up on any sessions that you missed in the plan sponsor track, which is where you are now, or the advisor track, which is happening right next door. Today, we're going to talk about a safe harbor match and adding a cash balance plan, and also loans and distributions. Show me the money. That's what we're calling it. So we've got some great sessions planned for today. And I just had a couple of quick notes that I wanted to remind you about. We will be taking questions at the end of each session. So if you have a question for any of our presenters, feel free to enter that in the chat and I'll be watching so that I can ask those questions to Kim or Dawn or Anna after the presentation. And I've already said that all the sessions are recorded. We will send you an email early next week when all of those sessions are posted online, along with a link as to where you can find it and any of the other resources that we're making available for these particular sessions. So I want to make sure that I thank our sponsors because without them, this really wouldn't be possible. They're great partners to have on our team, and I just want to say thank you to them. So thank you to John Hancock, American Funds, Securian Financial, Principal, Voya, Penchecks, Empower, Transamerica, Lincoln Financial, T. Rowe Price, The Standard, and Vanguard. Honestly, without them, we would just be a one-person group on one-legged stool here. So we're really grateful for their support and partnership. So let's move to the next session. I want to introduce Kim Patty, who's going to talk to us about the perfect match. Kim, the floor is yours.
Great. Thanks, Elke. Hi, everyone, and thank you for joining me today. As Elke said, I'm Kim Patty, and I'll be doing the presentation called The Perfect Match. Believe it or not, this is not about a new reality dating show on Fox. We will be going over the basics of safe harbor plans. So I'm a manager here at Definiti, working in the defined contribution area. I have over 25 years of experience working on retirement plans, both defined benefit and defined contribution. Before we begin, if you have any questions, please add them through the chat, as Elke said. We are planning on leaving some time at the end of the presentation to go over any questions that came up. Safe harbor 401k plans have become very popular, especially with small business owners, because they give you a free pass on certain compliance tests. And they allow for greater savings flexibility for your highly compensated employees, which we refer to as HCEs. HCEs are those earning more than $135,000 in 2022, or people who own more than 5% of your company. When your 401k plan includes a safe harbor provision, you commit to a minimum level of employer contribution for participants. And that contribution would either be a percentage of compensation or as a match. So whether you're starting a new retirement plan or you want to improve your current one, it may be worth considering adding a safe harbor provision. Safe harbor may be appropriate to add to your plan if you're moved to help employees save for retirement. Adding a safe harbor match may provide incentive for employees to contribute more for themselves. It may be appropriate if you plan on making employer contributions anyway. If you're going to be depositing money into the plan, it may make sense to amend your plan and deposit it as a safe harbor contribution. It might be appropriate if your current retirement plan has recently failed compliance testing. Well, how would you know if that would happen? You would know because your highly compensated employees would probably have to take some of the money that they put into the plan back out of the plan after the end of the plan year. We at Definiti would do this type of testing for you after the end of the year. That test is called the ADP test. And what we do is look at the percentage that the highlies put in and compare that to what your rank and file or your non-highly compensated employees put in. And the IRS only allows your highly compensated employees to put in a little bit more than what everybody else puts in. And if not, there's a chance that those highly compensated employees will have to take that money back out. There's also the chance that somebody told you from Definiti that, hey, your plan is now top heavy. So the top heavy provisions mean that you would probably have to put in a contribution to the plan anyways. So if you had either of these things happen to you, it may be appropriate for you to add safe harbor. Another reason is if your highly compensated employees aren't able to contribute the maximum because they're afraid that they might fail the test. Maybe it's happened in the past and these employees have had to take out money and they didn't really like that. So maybe that would be the case where you would want to add safe harbor. Or maybe your highly compensated employees don't contribute for fear of taking money back. This adding safe harbor would allow them to contribute the maximum for the year. And also, if you have low participation in your current plan among your lower compensated employees or staff, adding the safe harbor will get that money into the plan for them and help them save for retirement. All of these may indicate that you should look into adding a safe harbor feature to your plan. We're going to go over 3 safe harbor options. The non-elective, which is generally a 3% non-elective contribution, and it must be provided to all employees eligible to make elective deferrals to the plan. Doesn't necessarily mean that they actually make them, but if they're eligible to make them, they would be eligible for the non-elective contribution. The non-elective contribution may be either a guaranteed contribution or a flexible contribution. And this is an election that's made in your plan document. There are a few types of matches that we're going to go over. Basic safe harbor match, enhanced safe harbor match, and a safe harbor match with automatic enrollment. Now, these contributions are only allocated to employees who defer their own money into the plan. So not only do you need to be eligible to participate in the plan, you also need to make deferrals of your money in the form of either 401k or Roth contributions in order to receive a match. Now let's take a look at what these safe harbor contributions look like for different deferral levels. Option 1 shows a safe harbor 3% non-elective. Also, I should note 3% is the minimum. You could put in a percentage higher than 3%. As you can see, no matter what the participant chooses to defer, the participant always receives 3% of their compensation as an employer safe harbor contribution. Again, if they elect 0, or if they say they don't want to be in the plan, or this person doesn't have an account set up, it really doesn't matter. If they met the plan's eligibility requirements, they get a contribution equal to 3% of their compensation. Option 2 illustrates a safe harbor basic match, which is the most common safe harbor match. It is a dollar for dollar match on the first 3% deferred and 50 cents on the dollar for the next 2% deferred. So if an employee defers 5% or more, they will receive the maximum match of 4% under this formula. You could also have an enhanced match, which is similar to this basic safe harbor match, but it's more generous. Some examples of an enhanced match our match of 100% of deferrals up to 4%, or 100% up to 6%. Option 3 shows what's called a safe harbor match with automatic enrollment. This option is similar to the basic safe harbor match, but is slightly less expensive. It's $1 for dollar on the first 1%, and then 50 cents on the dollar for the next 5%. The maximum automatic enrollment safe harbor match is 3.5% compared to the 4% of the basic match. As you can see, you reach that 3.5% level if you defer 6% of compensation. And again, comparing that to the 5% to get the maximum safe harbor basic match. However, this match option requires the plan to use automatic enrollment. This is different in that participants will automatically have money withheld from their pay as soon as they're eligible, and they do have the option of opting out. Let's go over the required documentation for having a safe harbor plan. First, the plan document has to be amended to add the applicable safe harbor formula. Similar to other contribution types like profit sharing and deferrals, there is an entire section of the plan document that's dedicated to the safe harbor contribution. And there is also a notice requirement. So if you elect any safe harbor match type, you will give all eligible employees notice between 30 and 90 days before the beginning of the plan year. Additionally, if you have new participants who enroll during the year, they must be given the notice too. And most retirement plans have different entry dates throughout the year. Anytime the participant enters the plan, they would need to be given this notice. The automatic enrollment notice also needs to give details about the automatic deferrals. So in order to do the automatic enrollment match, the default deferral amount is 3% for the first 2 years, and it gradually increases up to 6% over the next 5 years. This escalation would be described in the notice. Now let's look in a little bit more detail about each of the different safe harbor contributions. First is a 3% non-elective contribution. There are 2 options for the safe harbor 3%, guaranteed or flexible, and that selection is made in the plan document. Guaranteed requires that a non-elective contribution be made every year. You would have to amend the plan to remove that provision. Flexible allows you to decide each year whether to provide a 3% contribution or not. Now, if you want to add a safe harbor non-elective provision to an existing 401k plan to take advantage of the safe harbor status for the year, you can do so at any time before December 1st, as long as you're willing to pay the minimum 3% contribution for the entire plan year. After December 1st, you can still add the safe harbor non-elective contribution for the year in question up to the deadline of December 31st of the following year. But you must increase your safe harbor contribution to 4%. Now, this is a newer non-elective rule that was part of the Secure Act. And it gives more flexibility for those plans who didn't know that they were going to fail that non-discrimination testing. The 3% safe harbor contribution must be provided to all non-highly compensated employees employed during the plan year, whether or not they made a salary deferral. It can, and often is, provided to your highly compensated employees. Now, there cannot be a last day requirement for this contribution or an hours of service requirement. If somebody was making deferrals throughout the year, but then they left employment, they're still going to be eligible to get this 3% contribution. Also, the Safe Harbor 3% has immediate 100% vesting. Generally, the plan is exempt from top-heavy minimum contribution requirements, as long as no other types of employer contributions are made to the plan. Now, the top-heavy test, that looks at individuals the IRS defines as key employees. So those are generally your officers and your owners. And what it does is measures the value of the assets in their 401k accounts and compares it to all of the assets held in the 401k plan. If those people have more than 60%, your plan is what is considered top heavy. And this safe harbor non-elective gets them out of that requirement. Also, if you make the 3% non-elective, highly compensated employees can defer the maximum. In 2022, the basic employee deferral limits for a safe harbor plan are the same as any other employer-sponsored 401k plan. $20,500 per year for participants under age 50, and then $27,000 when you include catch-up contributions for those employees who are 50 and over. So as an added benefit, with the safe harbor provisions in place and less to worry about when it comes to non-discrimination testing, owners and highly compensated employees can truly max out their deferrals. This means they can take advantage of these contribution limits. Now let's talk about the basic matching contribution. The formula, as you can see, is 100% of the first 3% of plan compensation plus 50% of salary deferrals up to the next 2% of plan compensation. It's provided to all participants with a salary deferral during the plan year. And again, you cannot have a last day or hours of service requirement. And it has immediate and full vesting, just like the safe harbor non-elective contribution. The plan is exempt from top-heavy minimum contributions if deferrals and match are the only contributions made to the plan. The enhanced match works just like the basic match. It's just more generous. Examples are 100% of salary deferrals up to 4% of plan compensation, or 100% of salary deferrals up to 6% of plan compensation. The enhanced matching contribution rate may not increase as the percentage of deferrals goes up. Just like the basic safe harbor match, it's provided to all participants who have a salary deferral during the plan year. You have to defer in order to get the match. And you cannot have the last day requirement or hours of service requirement. There's full and immediate 100% vesting, and it's there to take with them when they leave employment. The plan is exempt from top-heavy minimum contributions if deferrals and match are the only contributions made to the plan. Now let's look at the match with automatic enrollment. This is often referred to as a qualified automatic contribution arrangement, or QACA match. As an opt-out plan, employees will automatically be enrolled with a matching contribution unless they choose to leave the plan. The document must specify minimum default percentages, starting at 3%, that gradually increase with each year that an employee participates. So if an employee does not opt out, they will automatically have 3% withheld from their pay when they become eligible. The default deferral percentage cannot be less than 3% for the first 2 years of participation. It increases to 4% during the third year, 5% during the fourth year, and 6% from then on. Now, you could choose larger percentages to automatically enroll people in. If you choose 6%, the escalation that I just described isn't required. However, the maximum default deferral percentage can't be larger than 10%. The safe harbor with automatic enrollment match formula is listed here. the match formula is 100% of the first 1% and 50% between 2% and 6%, with a maximum match of 3.5% at the 6% level. You may not match salary deferrals in excess of 6% of plan compensation. Also, there's a 2-year cliff vesting schedule associated with this type of contribution. So unlike other types of safe harbor contributions, the automatic enrollment safe harbor match is not necessarily immediately 100% vested. Now let's look at a few examples. First, we have an eligible participant who has compensation of $50,000 during 2022 and elects to defer 0%. What is the safe harbor non-elective amount? That safe harbor non-elective is simply planned compensation times 3% if they're eligible, which as you can see is $1,500. Now, what would the employer have to contribute for any of the safe harbor matching options? Well, in order to get a match, you have to put your own money into the plan. Since this person decided to defer 0%, any of the safe harbor matching contributions would be 0. In another example, we have an eligible participant who conveniently has compensation of $100,000 during 2022, and they defer 8%. What is the safe harbor non-elective amount? Again, this is simply compensation times 3%. It is not based on what they defer, so it's $3,000. Now, what would the employer have to contribute for any of the safe harbor matching options? Well, in order to get the basic match, you have to contribute the maximum basic match, you would have to contribute 5%. The enhanced match assumes we're doing 100% up to 4%. They're doing more than 4%. And the automatic enrollment match, you would have to defer 6% in order to get the maximum. And since this person is deferring 8%, they're deferring higher than the maximum at all 3 of these matching contributions. So the matching contribution, the basic safe harbor match would be 4% or $4,000. The enhanced match, again, using the formula of 100% up to 4%, would be the same $4,000. And the automatic enrollment match would be $3,500, since 3.5% is the maximum automatic enrollment safe harbor match. Now, as you can see, the match may look more expensive, but keep in mind that the participant on the last slide deferred 0 and didn't get a matching contribution. The non-elective contribution goes to everyone. In our final example, we have this eligible participant who still has the compensation of $100,000, but this time they're only deferring 4%. So the safe harbor non-elective amount, again, it's not based on what they defer, so it's the same $3,000 as the last example. But what would the employer have to contribute for any of the safe harbor matching options? They're doing 4%, they're not at the maximum level for the basic safe harbor match, so they would get a 3.5% contribution or $3,500. Now they are at the maximum for the enhanced match, so they get the full $4,000 if you used an enhanced matching contribution formula. And the automatic enrollment match would only be 2.5% of compensation or $2,500. In this case, the automatic enrollment match is the least expensive option. So let's talk about some of the other benefits of automatic enrollment. Automatic enrollment plans have much higher participation rates than plans without this feature. As you can see, it's about 87% compared to 60% for plans without it. Additionally, like we talked about before, for the first 5 years, the rate of deferrals increases automatically. So not only are more people saving for their retirement, they're also automatically saving more each year and receiving a match. An important note is that unlike the 3% or the basic or enhanced match, which are required to be 100% vested at all times, as I mentioned, vesting for the automatic enrollment match can be 100% after 2 years of service. If the employee doesn't get 2 years of vesting service, they would forfeit that money that was contributed to them contributed to them in the automatic enrollment match. The main benefit of having a safe harbor plan is that free pass that we talked about earlier. If one of these safe harbor options is selected, the plan isn't subject to ADP or ACP testing. So regardless of what your rank and file employees contribute to the plan, your highly compensated employees can maximize their deferrals for the year without worrying about it being refunded to them after the end of the year. So again, if you have a plan that typically fails testing, safe harbor may be the way to go. Now we have some common questions. First, can safe harbor contributions be stopped during the plan year in the event of financial setback? If the 3% guaranteed non-elective is stopped mid-year, you're still required to provide that contribution to the date of the amendment that stops the contribution. But if instead they had the flexible contribution, well, you haven't committed to that contribution yet. And so you wouldn't have to actually make that contribution. Also, the matching contributions that we went over, they do allow you to stop making safe harbor matching contributions during the year if needed. You have to provide a written notice to the employees at least 30 days before the contributions are to be stopped. And the employees have to be given the opportunity to change their deferral election. However, the contributions still have to be made to the effective date of that notice. And then if you stop making those contributions, the ADP and ACP tests will apply for that plan year. Another common question, can a plan become safe harbor plan mid-year? Well, usually safe harbor plans need to be for the entire plan year. Mid-year adoption is possible for new plans or profit sharing only plan that adds a 401k feature. For new plans, October 1st is the final deadline for starting a new safe harbor 401k plan. If you want to add a safe harbor matching provision to an existing 401k plan, you can amend the plan effective January 1st of any future year. Remember, there is a 30-day notice requirement for employees, and it could take a little bit of time to get the plan amended. So try to get that taken care of sooner rather than later. As always, if you have any questions, please reach out to your retirement plan consultant at Definiti. Elke, would you like to talk about the available resources?
Yes, thank you so much, Kim. I really appreciate your careful attention. There's a lot of percentages in there, but obviously the benefits for Safe Harbor are really worth looking at. So Kim did mention we do have a couple of resources for you. Obviously, this session is being recorded and will be available. It will be posted online so you can watch the replay. We also will share two other resources in the same place where you'll find the link. One of them is an insights piece that talks specifically about safe harbor plans. And then another one that gives you the formulas that Kim mentioned there in her presentation. So both of those will be good takeaways that you can use as you're considering whether or not you want to add a safe harbor plan or provision. And remember, you can certainly talk to your RPC and have them help you along with any of the questions that you might have. Now, Kim, I do have a couple of questions for you, so don't go too far. So we had a couple of questions. One of them is, can an employer put an additional match over the safe harbor limit?
Yes, in general, that can be done as well. So you can have a safe harbor contribution and another match associated with the plan.
Perfect. And are there max company contributions percentages set by the IRS?
Well, in general, your maximum company contribution is 25% of all your eligible employees' compensation. So that would be the maximum amount that you could put in. Good. And there were new ones that just came out, right? You kind of mentioned it. We've been working, we've got 2022, but then 2023 contribution limits just came out just last week or so. So let's see. Here's a question. If the plan has an auto enrollment feature, are you required to use the auto enrollment match formula, or can you choose to match on one of the other formulas? That's a good question. I would imagine that you would be able to match using the one of the other formulas, since they're more generous than the automatic enrollment match.
Great, that's a great thing. So what we'll do is we've got a record of all these questions, and we'll make sure we include that as well. So thanks for that, Kim. Appreciate that. Wow, they're really coming in now. You've given a good topic. So back to the question about additional contributions. Is that a one-time contribution for the employer? Or could they make it several times throughout the year?
Right, it depends what's written in your plan document, if it's allocated per pay or if it's allocated at the end of the year.
Great. Yeah, those are great questions, everyone. I'd encourage you, Kim's done a great job in answering those for us today. As you go through the day and you're thinking more about Safe Harbor and is that a good match for you, please don't hesitate to reach out to your retirement plan consultant here at Definiti. They know your plan and are familiar with your plan document, so they can help guide you in what is the best option for adding any of those
options.
So Kim, thank you so much for your presentation. We appreciate it so much. And
You're welcome, Elke.
Thank you, Kim.